In this presentation, we'll be presenting the rules and showing examples of the R3 trading strategy. This strategy was first published in the TradingMarkets book, High Probability ETF Trading Strategies. The rules are designed to identify a long-term uptrend and then a pullback during that uptrend. The strategy is based on the two-period RSI, RSI being the popular relative strength index, calculated with just 2 periods. By identifying ETFs that are above their 200-day moving average, we find ETFs in long-term uptrends. When the RSI-2 drops for 3 days in a row, we've identified a short-term downtrend. And this will be clearer when we provide an example, but we want all 3 of those drops to occur below the 60 level. And as I said, we'll have an example to highlight this. When the two-period RSI closes under 10, the ETF is a buy, and trades should be entered on the close that day. The rationale behind the rules is straightforward. We're buying ETFs in long-term uptrends on short-term pullbacks. More aggressive traders can add a second unit if the price closes lower than the initial entry price on any day after the trade is opened. Units can be thought of in dollars or share amounts. If you're trading $10,000 per position, a second unit would be $10,000 worth of the ETF. If you're trading 100 shares, a second unit would simply be another 100 shares in your account. Because this is a high probability strategy, adding to position on weaknesses should increase profitability, and we'll show with test results that it does. To exit trades, we'll exit at the close the day the two-period RSI closes above 70. This will indicate that the ETF is moving into an overbought position. Test results were first presented in 2009, and they have held up over the years according to subsequent testing. Average trades gained nearly 1% and were held for 5 trading days. More than 3/4 of trades were winners. The table shows the record of all ETFs included in the test. The aggressive trading results show that the average gain per trade was increased, and the percentage of winners also rose. Of course, the average holding period is unchanged since the aggressive version does not change the exit rules. Here's an example. What we're looking for is for the ETF to be above its 200-day moving average, and that's not shown in this chart. We do want to see the two-period RSI drop for 3 days in a row, and that occurs as marked here. And the actual entry would be at this position. Now, as we said, we want the RSI to drop from 60. So on the first day of the drop, we want it to be below 60. Then we get the second day of the drop and the third, and that is when we enter the position, provided that the two-period RSI is under 10 at that point. Once the trade is entered, as we see here, we achieved that drop on 3 consecutive days. Once the trade is entered, it's exited when RSI closes above 70, which in this case occurred on the very next day. Here's another example with the aggressive version. We have the first day of the drop where RSI is declining, and we have 3 consecutive days where it declines. And it starts its decline from below the level of 60. So we have 1, 2, 3 days. We enter the trade. Subsequently, the ETF did close lower, and a second unit was added. The second unit, in effect, lowers the position entry price and results in an increased profit on this trade. In summary, R3 is a high probability, low frequency trading strategy. we encourage you to consider trading several high probability, low frequency trading strategies on both the long and the short side to help you increase the probability of your success under any market conditions.